Hey everyone, Jonathan Lee, real estate sales representative based out of Toronto. It's the start of April and this new province-wide shutdown is a huge bummer, but I am so glad that spring is springing. The days are getting longer, the weather's getting a little bit warmer, and the sun is coming out, really helping to brighten my mood. I just want to make a quick shout out to my neighbor Dave who gave me this driveway haircut. Helped me keep a little cool and stay professional looking. Yeah, like the back of my hair was just driving the back of my neck crazy. So you're hearing it everywhere. It's all over the news. The real estate market continues to plow on forward, and this, as well as the vaccination rollout rates, seems to be the only things that the news outlets can talk about. If you're a first-time homebuyer, it is definitely very competitive, and you need to have a very good handle on your budget, which is why I'm here to talk to you guys today about how major banks qualify you on your mortgage. So we're going to look at some of the rules and ratios that the banks look at, and I also have a Microsoft Excel mortgage calculator tool that you can download in the description box below. But to start things off, I should say that I don't work for a bank and I'm not a mortgage broker. I'm a realtor. So everything that we're going to talk about does not replace actually getting a full mortgage pre-approval done by your bank or your mortgage professional, as well as some of the ratios and in the tools and the calculations are subject to change. So if you're using this some years later, it might not apply, but this is what we're going to do today applies to things today. We're going to start off going high level in what the banks look at and what some of the mortgage terminology means. And then we're going to go through 3 different scenarios and use the Microsoft Excel tool to illustrate how it actually might play out in a real life situation. So if there aren't any questions, let's get into it. So for those unfamiliar with how a conventional mortgage is structured, you have your mortgage interest rate, your mortgage term, and your amortization period. Mortgage interest rate is either fixed or variable. Fixed means that it's locked in for the contract that you have with your bank who's giving you your mortgage. Variable means that interest rate is subject to change. And that interest rate is usually tied to the Bank of Canada's prime interest rate, which is directly tied to the performance of the economy. So when things are good, the interest rates go up. When things are not so great, they either stay the same or they might go down. Now, of course, we want a lower interest rate. That means that our monthly payments will be lower on the property. So mortgage term is a length of time that you're locked in with the bank that's giving you the mortgage. The most common term is 5 years. However, there are shorter and longer terms that are available. Once that 5 years is complete, you can transfer your mortgage to a different bank and sign a new contract, at which point that new bank will pay out the old bank for what's left on the mortgage. And then your business will be done with your previous bank and you will start a new business with your new bank. Amortization period is the number of years that your mortgage is spread out against. So the longest period of time is 30 years, and generally you would want a longer amortization period because your loan repayments will be split over a longer period of time, which means that your monthly payments would be smaller. So of course, if you're borrowing $1 million, it would be less per month to pay it over 30 years rather than 5 years. The majority of buyers will choose either a 25-year or a 30-year amortization period to maximize their budget. However, shorter amortization periods are available. Now, to purchase a property, you will require a minimum down payment of 5% if your purchase price is up to $500,000. For a purchase price between $500,000 and $1 million, you will need 10% for that amount beyond $500,000. And for a purchase price of $1 million and above, your minimum down payment needs to be 20%. So just to give you a little bit of an illustration, if you're purchasing a property and you're purchasing it at $500,000, then your minimum down payment can be $25,000. If your purchase price is $800,000, then your minimum down payment can be $55,000. So that's $25,000 for the first $500,000, which is 5%, and then $30,000 for the price between $500,000 and $800,000. So that's 10%. And if you purchase a house that's $1 million, then the minimum down payment that you would be allowed is $200,000, which is 20%. Now, a couple things to note: if your down payment is less than 20%, which also means your purchase price is under $1 million, is that you will be required to purchase mortgage insurance for your bank. And this mortgage insurance isn't protecting you. It's actually protecting your bank because you have a higher ratio mortgage, which puts you at a slightly higher risk category. And this insurance isn't cheap. The cost of the premium actually gets added onto your mortgage. However, the PST for this premium is due upon closing and payable to the government. As well, if your down payment is under 20%, you don't qualify for a 30-year amortization period. Actually, the longest amortization period that you can qualify for is 25 years. Now, this matters because the longer the amortization period that your mortgage is spread over, the lower your monthly payments, which means that you would actually qualify for a higher mortgage amount using the qualifying ratios. Now, banks look at three main things to qualify you for your mortgage: your credit score, your gross debt service or GDS ratio, and your total debt service or TDS ratio. Now, so firstly, your credit score should be above 700. If it's not, and it's due to relatively minor infractions like a couple missed cell phone bill payments, then the bank might still qualify you for the full amount that you would qualify for. However, it's really up to the discretion of your bank, and I don't really quite have access to that. So generally speaking, your credit needs to be pretty good. Next is the gross debt service ratio or GDS ratio. And this is basically says that your housing costs can't be more than 35% of your before tax income. Now, these housing costs, according to the bank, are your mortgage payments, your property taxes, 50% of your heating bill, and if you're in a condominium, your condo maintenance fees. Now, I say housing costs in parentheses like this because these are by far not all your housing costs that you would actually have to pay. You'd actually have to pay house insurance, home insurance, water, gas, and of course ongoing maintenance and upkeep. But according to the banks, they only qualify you against mortgage payments, property taxes, 50% of heating, and if you're in a condo, your maintenance fees. Now, the third thing they qualify you against is your total debt service or TDS ratio. And this basically says that no more than 42% of your before tax income can go towards all your home costs, as I just mentioned, according to the bank, and any financial and debt obligations that you might have to pay. So things like student loans, car payments, credit card debt, spousal or child support payments, pretty much any financial obligations that you have to meet. That and your housing payments cannot exceed 42% of your before tax income. Now, it should be noted that certain obligations are excluded, like pension payments, pension fees, as well as union dues, such as if you're either a teacher or work in manufacturing. But what's interesting about these GDS and TDS ratios is that, one would think that they would actually go against the rate that you actually get from your bank, which right now are at historic lows. But it's actually calculated using the higher of either your interest rate that you actually get, plus 2%, or the Bank of Canada's 5-year benchmark rate, which right now is 4.79%. So pretty much all mortgages are being qualified against 4.79%. And this is due to the mortgage stress test, which was instituted back in 2018. Which basically was to curb speculation and make sure that as interest rates rise, home buyers would be able to afford their homes. So you're qualified at a higher rate than you actually pay. It's interesting to note because even though home prices are really going active and crazy right now, the mortgage rules in Ontario are actually very stringent. Let's see how this all works with a couple different scenarios. So this is the mortgage calculator tool that I use. It's simple to use. The yellow cells are the editable cells. All other cells are locked just to keep things simple. So up top, the user fills out their basic information, purchase price, their total annual income before taxes, and the down payment. Just below that, you'll see details pertaining to the mortgage, the loan to value ratio, whether mortgage insurance is going to be added onto the property, and in this case, since it's at 20%, it would not be required. Beside that, you see the summary of the mortgage, and this is going to be the details depending on the type of mortgage that the buyer chooses. So here we have an interest rate of 1.5, an amortization period of 30 years. I've defaulted the terms to being 5 years. Below that, you're going to see all the properties, the details pertaining to the property and the actual financial profile of the buyer. And so you have your annual taxes here, your expected monthly heating costs, any monthly maintenance fees, such as if it's in a condo. And here are the details of the financial profiles and their loan obligations and debt obligations, student loans, credit cards, car loans, or lease payments, any spousal support payments, things of that nature. And below that, I have other details pertaining to home expenses. This doesn't affect someone's ability to qualify for a home, but I just put it in there just because it's good to see what your actual total expected monthly payments are. Here, it's good to note that you have your mortgage qualifying rate, and then you have your actual mortgage amount based off of what this actual interest rate and amortization period is going to be. I've added in some conditional formatting and some formulas into the tool just to warn the user if their down payment or purchase price disqualifies them at a proposed purchase price, or if their GDS and TDS ratios are beyond the limits. So just as an example, if we change the down payment to $199,000, the down payment gets highlighted in red because from $1 million and up, at a purchase price of $1 million and up, they require a minimum down payment of 20%. And of course, the amortization period would be affected. So if we change this as well to $950,000, the purchase price to $950,000, and the down payment to $150,000, you can see the amortization period gets highlighted in red because for it to be a 30-year mortgage, you require a minimum of 20% down, and $150,000 is not 20% of $950,000. So let's change this to 25 years, which would be the maximum allowed at less than 25. And you can see as well here on the left that mortgage insurance would be applied. So the total mortgage would actually be $822,400. And then, while the GDS and the TDS ratios, the TDS is still green because there's no additional, this buyer doesn't have any other financial obligations. The GDS gets highlighted in yellow just because it is beyond the 35%, but it's under the 40%, at which point, the buyer would want to consult with their bank or mortgage broker to see if, based off their financial profile, there's a bit more flexibility to be able to purchase at this price. And there can be in between 35 and 40%, I'd say. There can be some exceptions that are made, so it's better to check on all that. So for case A, we're looking at Luke and Donna, who are both teachers and earn a combined income of $160,000. They have $110,000 saved towards the purchase of their first home. They pay a combined $500 a month on student loans and $300 on monthly car payments, but otherwise the couple doesn't have any other debt obligations. So they're wondering if they can afford to purchase an $850,000 starter home. So after inputting everything in here and putting in a 25-year mortgage at an interest rate of 1.5%, we can't increase this beyond 25 years because they don't have the 20% towards a down payment. It looks like we're right around the threshold based off of the profile of the home that they're interested in, with the annual property taxes being about $4,000 a year of being able to afford it. So we're a little bit beyond the limit, but right around 35%, at 35.6%, I'd say most likely that a bank will accept this profile, especially considering that they're in an industry as teachers where their employment is quite secure. You can see that based off of their monthly obligations, financial obligations, they're pretty close to the threshold of 42%, but still under it. And at this interest rate and price point, their actual mortgage payment would be closer to $3,000 a month, even though the qualifying rate will be $4,400 roughly. And their actual true home expenses, if you include all their water bill, their property taxes, their gas, their home insurance, is probably going to look closer to $3,700. However, this wouldn't include, internet actually in the home. Another thing to note here as well is that their loan-to-value ratio, it's above 80%, meaning that they're borrowing more than 80% of the value of their home. So they would have to purchase a mortgage insurance for their bank. The cost of that will be almost $23,000, and that will be added onto the total mortgage amount for the house. So the next case that we're going to be looking at is Tyler. Tyler is recently divorced and pays child support payments of $2,000 a month. He earns $120,000 per year and has $400,000 from the proceeds of the sale of his house from his divorce that he can use towards the purchase of his next home. He has no other debt or financial obligations, and he's looking to buy a condo. How much can he afford? So here's a picture of Tyler from his new dating profile. We're gonna say this is actually just a stock image of a middle-aged man. So what's interesting about this is Tyler probably imagined himself to be in a much nicer home than he can probably actually afford. He's actually most throttled by his monthly child support payments of $2,000. So based off of all the criteria and everything that we've put in here, he's got a strong annual income of $120,000, a very good down payment of $400,000, and we're putting in we're assuming an annual property tax of around $2,500 and monthly condo maintenance fees of around $600 a month. And so you can see he's not throttled at all. He's got a lot of space in his GDS. But once we add it all together, assuming a $650,000 purchase price, he can really only afford. He's right around 42%, and basically, $650 is going to be roughly the maximum that he can actually afford. He can't go really much higher than that. I mean, even if we try to put in $660, he's at his max. He's above the limit. So I mean, this is all quite interesting to note, just to see that divorce can actually be the most financially devastating event to happen to a person. And so I'm just trying to illustrate how all these things and these different financial obligations can affect a person's ability to qualify on a home. So the last case that we're going to explore together are Adam and Michelle. Adam and Michelle are engaged and looking to buy a home together. Adam likes cars, boats, flashy things, and currently leases a luxury car with 9 months left on the lease at $1,500 a month. He's got $25,000 of debt on a boat at monthly payments of $1,200 a month, and student loan debt of about $90,000 at $600 a month that he pays to service it. He earns $160,000 a year. He has savings of $100,000. And Michelle earns $140,000 a year and has savings of $400,000 that she could spend towards their future home. She does not have any other debt obligations or financial obligations. They're looking to buy a $2 million home together. Can they afford it? So, based off of their initial financial profile, a combined income of $300,000, $500,000 down payment, they can, of course, afford a 30-year amortization. And based off of everything there and the proposed property that they're looking at having annual property tax of roughly $8,000, yes, they can afford it. Their GDS ratio is below the threshold. However, Adam's expensive spending has put them outside of the TDS ratio to actually get the mortgage. So they would have to clean things up a little bit. So right off the bat, probably the best things to do are getting rid of the boat and the car, and paying off the boat and getting rid of the car. So the luxury car has only 9 months left. You can probably return that early, pay a penalty fee of roughly $13,000, and so we can actually effectively eliminate this. And the boat has $25,000, which is a lot of money, but would actually help them get the property and give them a bit of breathing room because they wouldn't have to pay the $1,200 a month. So if we eliminate this, then the only additional financial obligation will be the $600 a month to service his student loans. Now, of course, they could also pay that off, but it is $90,000, and so it would be a significant chunk out of their down payment. So it's probably better, especially at lower interest rates, to just leave it at the $600 a month, and they'd be able to afford it, even with the down payment being effectively reduced by $38,000. So let's bring this down to $462,000. And while the GDS ratio is slightly above 35%, I'm pretty sure the banks are gonna overlook this and still give them the mortgage. So based off of all this, yes, they can afford their $2 million house. It's just gonna take a little bit of finagling and moving things around and paying off some of these financial obligations to be able to do it. Thanks so much for watching, everybody. If you're enjoying the content, smash the like button and hit subscribe. For any questions, love or hate mail, or just any inquiries, you can hit me up at johnleehomes.ca on Facebook or Instagram at torontos.johnlee, or you can shoot me an email through johnleerealestate@gmail.com. See you guys in the next one.